again, Polly Middlehurst here at Proactive Investors in London, and I'm going to be speaking next to Capital Networks analyst James Dolman, who's going to talk us through PCF interim results and other subjects. And incidentally, before we begin talking to James, don't forget, of course, for the full report on this, click the I in the corner of your screen. So, James Dolman, welcome. Talk us through these interim results. What are the numbers?
Yes, hello there. The group has produced an excellent operational and business performance with their half-year results to the end of March, and a very credible financial performance also. Strategically, the group has set out to deliver growth in the balance sheet, and this has been achieved as forecasted. Net portfolio assets have grown to nearly 180 million, which is an increase of 40% year-on-year. Gross assets, which include the unearned future income and provision, increased to 220 million, an increase of 40% also. This is achieved by the growth in the underlying business lines. Business finance, which is the lending to the SME sector, which is small, medium-sized enterprises, achieved a 111% increase in new business originations, driven by an increase in average loan size and by the new business lending into the prime market. Consumer lending, which is lending to the second-hand auto market, increased new business originations by 81%. Both segments benefited from the new pricing achieved by the commencement of retail deposits. The financial results were impacted by the 2 million of upfront annualised cost increases and the share dilution from the capital raised previously. Shares were diluted by around 25% increase in the weighted average for the period. However, statutory PBT, that's profit before tax, did increase by 20% to 2.1 million, although earnings per share were flat at 0.8 pence due to the weighted average share increase.
James, you mentioned retail deposits there and the commencement of those. Have they affected the group? Can you tell us a bit more detail about that?
Yes, absolutely. Yeah, markedly so. The retail deposits commenced in July of last year, and after 8 months now total 108 million, around 50% of the funded gross balance sheet. Retail deposits have been collected at the rate of somewhere between 8 to 13 million a month, depending on the competitive rate and funding requirements required by PCF. Wholesale funding continues to fall in line with the maturing underlying credit, or where economic to do so, retirement. Wholesale funding costs the group around 6%, whilst new retail deposits have a blended rate around 2%, and this saving is now being passed through to customers in the form of expanded lending into the prime market. The top 4 credit grades, that's the A's plus B+, now account for 70% of lending, up from 63% in 2017 and 57% in the first half of 2017. The group is also guiding to the commencement of corporate deposits in the third quarter of this year, which should also boost lending and or earnings per share accretion. In addition, and lastly, the group took the opportunity to borrow using the Bank of England's term funding scheme, from which it borrowed 25 million at a very preferential rate. We see this as a tactical decision rather than a change in strategic direction. Access to these funds is for 4 years and will be earnings accretive once deployed.
So those retail deposits that you mentioned just then, that 13 million figure, all tied in with this relationship concerning good performance, good credit performance. Has credit performance changes affected the company in the last 6 months?
No, not particularly. It's remained very strong. Performing gross loans remain high. It's around 92% of the gross book. Non-performing loans, that's the lowest class of performance, remain low at around 4.5%, but in absolute terms, these have risen in conjunction with the rise in the balance sheet from 9.1 million out of 222 million gross. The impairment charge was 0.7% of average assets. In absolute terms, the impairment charge of just under 600,000 was covered by that utilised for bad debt, such that the provision has once again risen and now stands at 4.4 million, or 2% of gross loans, or 44% of loans not performing. Credit performance, therefore, has overall remained very strong.
Good to hear all that. So for 2018 and beyond, what are your expectations?
The strategic direction of the group has not changed. Their forecast is still for looking to achieve around 350 million of portfolio assets by 2020 and 750 million of portfolio assets by 2022. They expect an ROE target of around 12.5% by 2020. We see portfolio assets now growing to 215 million by the end of this year, up from our previous forecast of 200 million. We therefore consider that the group can achieve our 3.84 pence of earnings by 2020 and will continue to grow those earnings beyond that point. This compares very favourably, we believe, with the current share price, and we would further believe that investors should continue to consider owning PCF shares.
James Dolman, thanks for that comprehensive update. Don't forget, of course, you can click on the I in the corner of your screen for James's full report on PCF.